How's it going, everyone? I hope you're all doing well. I want to welcome you to a brand new lecture in the Trading Protocol series, where in this lecture, we're going to discuss draw on liquidity. This is the second step in the higher time frame protocol. And so without further ado, let's get into today's lecture. Now, just to recap what we are trying to do here on the higher time frame protocol, first step is to identify order flow. Now, the reason why order flow is so important is because if order flow is bullish, we know that every retracement lower followed by expansion higher is a lower time frame market maker buy model, meaning manipulation lower, distribution higher, market maker buy model. And so the model that we're looking at on the higher time frame is expansion, retracement, expansion, and this retracement lower followed by expansion higher is our lower time frame market maker model. So in the previous lecture, we discussed order flow and how to identify whether order flow is bullish or bearish. Let's assume order flow is bullish, meaning price is expanding higher, retracing lower, expanding higher, retracing lower. Remember, we're trying to now frame that expansion higher. The only way we can do that is if we have two reference points. The first reference point we need is the draw on liquidity, because if the draw on liquidity has not been reached, then we can anticipate price continuing that bullish order flow into the draw on liquidity. If we assume that the draw on liquidity was reached here, then how do we know whether this move lower is a retracement or a reversal? Well, the probability that it's a reversal is much higher, and so we can't confidently say this is manipulation, which is going to be followed by distribution. So we need to have a draw on liquidity, we need to know that order flow will continue bullish, and of course, we need to have a point of interest, which is where price will expand from into the draw on liquidity, from POI to DOL. And this is what we call narrative, where price goes from point A, point of interest, to point B, draw on liquidity. We're not going to discuss points of interest in this lecture. That's going to be in the next video. But our focus today is on draw on liquidity and how to identify whether the draw on liquidity on the higher time frame is defined. And so what we're now going to do is we're going to go into replay and we're going to just identify order flow number one and then the draw on liquidity based on that order flow. So at the moment I'm on NASDAQ on the hourly time frame, and the first thing we need to do is identify order flow. Now, if you remember from the last lecture, what I said was this bearish order block, price is displaced above it, forming a bullish breaker. This is now the current invalidation for the buy program. What I also saw was we had this premium array, this bearish order block. Notice how many times it's been utilized as resistance. If price is placed above it, should be utilized as supports. So we know order flow is bullish, meaning we can target higher prices. Now, if we know order flow is bullish, and this is the invalidation for the current buy program, we now need to identify the next draw on liquidity. Now let's first utilize time cycles. Let's first go to the weekly time frame, and what I can see is we are currently inside of this previous week's range, where we have previous week low, previous week high. So I'm just going to call this previous week high, and I'm going to call this previous week low. So we're currently inside of the previous week's range. If order flow is bullish, previous week high is the draw. If order flow is bearish, previous week low is the draw. Very simple. If you now go back to the hourly time frame, this is now the previous week high. This is now the previous week low. What we've also got are previous day highs and lows. So we've got previous day high, which is Thursday. We've also got Wednesday's high, which is also a previous day high. Monday high, which is also a previous day high. Remember, we're not just referring to the previous day, we're referring to the previous days. Those are all liquidity that we can target. And so because order flow is bullish, I already have my draws on liquidity. Now, if we draw in the previous week's range, what we can see is price has been consolidating around equilibrium. We've now displaced above this order block. Order flow is now bullish. And remember what I said, any array that forms on the left side of the curve, meaning within this range here, on the left side of the curve, we can target as a PD array. So we have this volume imbalance here, which was reached. We have this small imbalance here. And so these are arrays that we can target because remember, price won't go to the drawn liquidity in a straight line. It will expand higher, retrace lower, expand higher, retrace lower, expand higher. We want to get out on that retracement lower because that retracement lower is going to be a sell program on the lower time frame. So if we continue, price is now displaced higher. Price is now closed above this price range here, which is also a previous week high, just a different week. This week we're referring to is from the 9th of March until the 14th of March, we have a new week here, which is from 17th of March to the 21st. We don't just refer to the previous week, but the previous weeks. Those are all targets for us. Price is now closed above here. This is now the invalidation for the buy program. If we now continue, and then finally, price takes out the previous week high. Now from here, either price is going to reverse or it's going to continue higher towards new draws on liquidity. Now, one thing we haven't discussed yet are fixed price ranges. Now, because we're looking at NASDAQ on the hourly time frame, I would suggest to use price ranges of 1,000 points. So in this case, 20,000 would be a range. We also have 21,000. So that is a range high to range low. I'm also going to draw in 19,000, which is here. So we have a range from 20,000 to 19,000 and from 21,000 to 20,000. I'm also going to draw in the midpoints. So 19,500 and 20,500. So what we can see is if we now combine our analysis from price cycles and time cycles, we can see we displaced above the 20,000s. Next drawn liquidity, remember, equilibrium, because we're now in a range from 21,000 to 20,000. If you imagine this is a denim range, the midpoint is 20,500, which is the next draw on liquidity because order flow is bullish. We can also see we've got this buy side liquidity pool that's at the 20,500 price level. And so as long as order flow remains bullish, we can anticipate price continuing towards 20,500s. And how price trades here will determine if we reach 21,000. Notice you have these buy side liquidity pools here. Or if we reject it and then continue lower, back to 20,000, and then from here to 19,500, and so on. And so the invalidation for the buy program right now would be this imbalance here, because we've displaced above this array that formed on the left side of the curve, on the right side of the curve. So if we just slowly play price out, we can see price is consolidating. Price then retraces into the imbalance, utilize that support, and then expands higher. We have this volume imbalance here as well, which if displaced above will become the new invalidation level. Price is now closed above it. So the new invalidation level now becomes this volume imbalance here. Price retrace into it, forms a low. Remember the drawn liquidity is still higher. Boom, price expands higher. Notice how you could have framed two market maker buy models here. We had bullish order flow, step 1. Step 2, drawn liquidity, 20,500. Step 3, retrace into POI. Price retraced into that inverse value gap, point of interest. This here is a market maker buy model. Same again, price displaced above the volume imbalance, retraced into the volume imbalance, utilized as support, expanded higher into the drawn liquidity. So there's two market maker buy models that you could have traded here. So what we can now see from here is that price has actually reached our next drawn liquidity. Now, as long as order flow continues bullish, we can anticipate higher prices, as long as the order flow on the hourly time frame remains in a buy program. Now, what I can see is prices displaced above these imbalances plus volume imbalances that will be utilized as resistance multiple times. And so this would now become the invalidation for the buy program, meaning as long as price remains above this price range, order flow is bullish, and we can anticipate further buy side to be reached. If price displaces below this price range, that would be a change in the state of delivery, and then order flow become bearish. Remember, we're only utilizing one time frame here. We're not utilizing multiple time frames. If we want to be more advanced, we could implement, for example, the daily time frame, because we need to know whether this entire move higher on the daily time frame is, for example, a retracement or an expansion. If it's a retracement, it's going to eventually end, meaning reversal is inbound, because an expansion lower will begin. Or if this is an expansion higher, then we can anticipate this entire move lower being a retracement, and then a buy program unfolding. Doing this on multiple time frames is going to increase the overall narrative that you can build, but it's not required. The only issue is if you're utilizing one time frame, we cannot anticipate reversals because we don't know whether this entire move high is a retracement or an expansion. The only way we can do that is by utilizing a higher time frame. But if we just stick to one time frame, such as the hourly time frame, as long as order flow continues bullish, next drawn liquidity is further buy sides. Invalidation for the buy program are these imbalances here. If you continue, price now displaces below the invalidation level, as well as this volume imbalance. And so, because a change in the state of delivery has occurred, and we've taken out the previous week high, we can anticipate price now reverting to, firstly, equilibrium of the previous week range. So we'll find a discount array that formed around equilibrium to target, and then how price trades there will determine if we're going to reach the previous week low, which is the opposing side of the range. That's our time cycle analysis. Our price cycle analysis is that prices rejected 20,500, produce CSD, and so we can anticipate price now reverting to 20,000 price level. Notice also we've got this new week opening gap here in the middle, which displays through the 20,000 price level. If price displaces below this, then we can anticipate 19,500 being reached next. And so if we just play price out, price utilized that volume imbalance as resistance and expanded lower. We've now displaced below these consecutive imbalances, as well as this bearish order block. So I'm going to utilize this entire price range as my validation, because we've got two arrays here that could be utilized as resistance. We've even got this tiny imbalance here that's been utilized as support that we can include. Because we haven't got any arrays that formed on the left side of the curve that have already been utilized as support. I mean, we've got this imbalance here, but this bullish order block and these imbalances here were not utilized as support, so we can't actually refer to the exact array that IPTA is referring to. So instead, we're just going to use the consecutive price range. As long as price remains below this price range here, order flow is bearish, price reaches the new week opening gap. Notice we form a low just above the 20,000 price level. This is engineered liquidity. Price is retraced higher now into that price range. We then reach the 20,000 price level. CSD would occur if we displaced above this imbalance here. But notice we just retraced into it, formed a high, and then began an expansion leg lower. We've now closed below this new week opening gap, which is now the new invalidation for the sell program. Notice how price rejected the 20,000 price level. That's perfect algorithmic precision. Remember, our drawn liquidity is now previous week low based on time cycles, as well as the 19,500 price level based on price cycles. And so anything above these price levels we can target as discount arrays that should be reached. We've got this bullish order block that formed just below equilibrium of the previous week's range. Price retraces higher, expands lower, reaching our first objective here. Now, if you remember, this here is the previous week low from the 17th until the 21st. This was the previous week high, this was the previous week low. Once price takes out a previous cycle high low, what we can do is we can utilize the entire candle that formed that previous week high low and utilize that as our invalidation level, assuming price displaces below it. And so this is now the new invalidation for the sell program. Remember, drawn liquidity, 19,500. Price reaches 19,500. Utilize it as perfect resistance and then expands lower. So what I've showcased to you is how you can blend time cycles, price cycles, as well as PD arrays to identify the draw on liquidity. Very simply, all we're doing is we're identifying the current time cycle range. Based on order flow, we're either targeting the previous cycle high around equilibrium, a PD array that forms around equilibrium, or the previous cycle low. And then we're doing our price cycle analysis. We're finding the current range that we're operating within. And based on order flow, we're either targeting the range high, equilibrium, or the range low. That is the process. And then within those ranges, we have PD arrays that we can target, because price will not move to the drawn liquidity in a straight line. It will expand, retrace, expand, retrace, expand. And so we're basically trying to get out at the next drawn liquidity. And so we're going to utilize PD arrays as well. So that brings us to the end of the lecture on drawn liquidity. Watch it a few times, apply it to your charts. The process is very simple. Order flow always comes first. And then based on order flow, we can identify the drawn liquidity. I hope you found some value from this lecture. And with that, I'll see you in the next lecture. Be safe.